Welcome to The Explainer. Today, we're diving into a genuinely wild story in the corporate world. We are looking at Vistance networks and a dramatic, high-stakes $10 billion corporate surgery.
I mean, seriously? What actually happens when a company decides to chop off 64% of its own revenue just to stay alive? Well, that's exactly what we're looking at with the massive $10.5 billion divestiture of the legacy CommScope business to Amphenol. See, the old company was this sprawling giant, just getting completely crushed by debt. So to save the patient, management made a really radical call. They cut away almost 2/3 of their revenue, selling off their legacy hardware to basically free a faster, nimbler engine from all that dead weight.
And the immediate result of that surgery? Absolutely staggering. $7.4 billion. That is the exact amount of debt that was instantly wiped from the balance sheet. They didn't just use the cash from the sale to pay down a little bit of their loans, they completely eliminated their debt and bought back all their preferred equity. By doing this, they yanked the company off life support and entirely removed what analysts call the insolvency discount. You know, that dark, heavy cloud that hangs over any company with a terrifying balance sheet?
To really wrap your head around this transformation, you have to contrast the old with the new. The old CommScope was, frankly, a bloated, debt-ridden maze. It was incredibly complex and slow-moving. Then you have the new Vistance, which officially emerged in January of 2026 as a totally debt-free, laser-focused, high-growth specialist. And being completely debt-free right now, especially in a market with rising interest rates, that gives them this incredible operational flexibility that their competitors can literally only dream of.
Okay, so after you carve away nearly 2/3 of a business, what is actually left over to power this newly reborn company? It essentially comes down to what we can call their twin engines. On one side, you've got Aurora Networks, which is completely focused on arming cable internet with the weapons it needs to fight back against pure fiber. And on the other side, you have RUCKUS Networks, and their entire mission is delivering flawless Wi-Fi in the most chaotic, high-density environments on Earth. Let's dig a little deeper into how these two distinct technologies operate as specialized weapons in today's connectivity wars.
So let's break down Aurora first. For years, cable companies have been absolutely terrified of losing ground to fiber-to-the-home networks, right? Well, Aurora uses a technology standard called DOCSIS 4.0 as a sort of Trojan horse to capitalize on this massive upgrade cycle happening across cable networks. They build the critical hardware. We're talking really powerful amplifiers and nodes that actually let cable operators push fiber-like 10 gigabit per second speeds over the copper lines they already have. This is huge because it means cable providers can offer ultra-fast speeds without the insanely prohibitive cost of digging up every street in America to lay brand new fiber.
And then you've got the other engine, RUCKUS. Their whole competitive moat comes down to this patented tech called BeamFlex. Think about being in a packed football stadium, a massive convention center, or a really busy airport terminal. Normal Wi-Fi just collapses under the strain of thousands of devices trying to connect all at once. While most Wi-Fi access points essentially just blast their signal out in every direction like a lawn sprinkler, BeamFlex acts way more like a smart, laser-guided missile. It actively steers the Wi-Fi signal directly to specific devices while completely ignoring the interference around it. That is exactly why their hardware dominates in those super chaotic spaces.
And look, all of this highly focused tech is already showing up in the financial vitals of this post-surgery company. If you look at their Q1 2026 results, it was an explosive beat across both the top and bottom lines. In its first full quarter, continuing operations saw net sales jump to nearly $472 million. That's a 21.6% year-over-year growth. But what's even more impressive is their core adjusted EBITDA, which is basically just a really great measure of pure operational profitability. That shot up 38.4% to over $87 million. It just completely proves the incredible leverage you get when you wipe out billions in debt and focus exclusively on high-margin, high-growth products.
And having that pristine balance sheet wasn't just some theoretical, feel-good thing for accountants. It meant immediate hard cash for investors. Almost right after the sale, Vistance completely shocked the market by rewarding shareholders with a massive $10 per share special dividend, which they paid out in late April of 2026. That was a really loud, unmissable signal to the market. This corporate surgery wasn't just about trying to survive, it was about rapidly creating massive value.
But right when you'd think management would take a breath and settle down, they announced even more surgery. Right on the heels of those Q1 earnings, Vistance signed an agreement to sell the RUCKUS business off to Belden in an all-cash transaction for roughly $1.85 billion. The CEO, Chuck Treadway, pointed out that this move unlocks even more equity value for shareholders and creates a ton of financial flexibility. But ultimately, what this means is that Vistance is shedding its second engine entirely. They are choosing to bet the whole company's future purely on accelerating the Aurora standalone business.
So, with all these massive rapid-fire changes, the market is frankly scrambling to figure out what this stock is actually worth right now. The most popular narrative floating around argues that the stock is severely mispriced, like roughly 47% undervalued. A lot of analysts have pinned a fair value estimate around $23.13 on the stock, which is a massive contrast to its recent trading price, which has been hovering around the $12.30 mark. The whole argument here hinges on the idea that the market simply hasn't caught up yet to the massive profitability and growth profile of this newly streamlined company.
But we have to talk about the Achilles heel here. It's a massive risk known as the Comcast dilemma. In 2025, a whopping 35% of the company's entire revenue was dangerously tied to just one single customer, Comcast. And that's actually up from 21% the year before. So, with Aurora acting as the primary growth driver through this DOCSIS 4.0 upgrade cycle, the entire fate of Vistance is heavily dependent on the spending decisions being made in a single corporate boardroom.
Right, because every huge upside has its hurdles. There are essentially 4 critical execution risks here. Let's call them the 4 horsemen of risk that could completely derail this whole turnaround story. First, obviously, is that heavy customer concentration we just talked about. Second is fierce pricing competition from massive giants like Cisco or HPE, which could really squeeze their margins. Third is the sheer challenge of actually cutting stranded corporate costs, basically all that bloated leftover overhead from the old giant company. And fourth, the looming threat that the broader industry just eventually abandons DOCSIS 4.0 entirely and pivots to pure fiber.
Because you have these massive tailwinds colliding head-on with some very real risks, mapping out the future price scenarios gets pretty wild. Analysts are modeling a huge spread between brilliant success and total failure. In a bear case, say the Comcast relationship goes south or competitors really start to bite, the stock could basically just stagnate around $12. But in a base case of solid execution and healthy margin expansion, we could see a $38 fair value. And in a bull case where DOCSIS 4.0 adoption just explodes flawlessly, shares could rocket up to $65. It perfectly illustrates just how much is riding purely on management's ability to execute.
Okay, so what should you actually be keeping an eye on to see if this turnaround is working over the next few quarters? 2 big things. First off, watch their progress in slashing those stranded corporate costs. Their future profitability really depends on them getting leaner. Second, pay close attention to the RUCKUS backlog before that build-in deal officially closes. Even though Aurora is dominated by Comcast, the health of the RUCKUS backlog kind of acts as an early warning sign, a canary in the coal mine, if you will, for the broader health and execution of the company during this incredibly transitional phase.
So this all leaves us with one pretty profound question. Is Vistance Networks a masterclass in corporate turnaround, a streamlined machine perfectly positioned to ride a massive tech upgrade cycle? Or is it just a really dangerous value trap, balancing its entire existence on the knife's edge of a single customer? Look, they survived the $10 billion surgery, but now the patient has to go run a marathon. It is a completely fascinating dynamic and one that is absolutely worth watching closely.